Hi, thank you for joining us today on Realty Check. I'm your host, Trish Williams. Thank you for coming back and watching our show. If you have been enjoying our show and you like the content that we're putting out, take a moment, give us a review, share this with your friends, follow us. We're on iTunes, Pandora, Spotify, Amazon Music, all kinds of different places out there. So follow us, and if you're watching us on Facebook, you can follow our page on Facebook as well. And we are going to be we're in our bonus series. It was originally going to be a 7-part series that we had on financial mortgages. And we were putting this whole thing together, going through the 7 weeks that we have, and we decided, or we figured out that we had never really touched on non-QM mortgages. These are the mortgages that are basically outside the box, not the things that we see traditionally, but another option for people out there. And we have our returning guest today, Gregory Cooke with Castle & Cooke Mortgage, that's going to explain to us what they are, how they work, who they work for, and if it's the right fit. So thank you, Gregory, for joining us again.
Good morning, good to be here.
Yes, you're a regular on the show now.
Fourth time?
Fourth time, and you're going to be back next in our next series. Our next series that we're having on the show is going to be a real estate purchase from start to finish. We're going to explain every single piece of what's in that contract, what to expect during the escrow, and break it down into, it's going to be a 7 or 8 week series again, and break it down piece by piece. So stay tuned and look forward to that one as well.
Great.
So Gregory, what is QM or non-QM?
Perfect.
What does QM mean?
Yep, great to start that way. So after the 2008-2010 financial crisis that affected the real estate market, affected by the real estate market, a new bureau in the government was formed called the CFPB, Consumer Financial Protection Bureau, that regulates all things financial, including the mortgage industry.
Okay.
And one of the biggest things they came up with, what they decided was a cause of the real estate meltdown was people's mortgages that not necessarily they could prove that they could afford the mortgage. A big thing called the ability to repay, ATR, ability to repay.
Okay.
And so a QM mortgage, a qualified mortgage, is full documentation loan that you can prove that they can repay the loan. W-2s, paychecks, all that sort of thing. Qualified mortgage. To be a qualified mortgage, then you can be sold off to Fannie Mae, Freddie Mac, VA, FHA, that sort of thing.
Okay.
So the opposite of that is then a non-qualified mortgage, and people get hung up on, well, if it's non, it must be bad or something like that. It just means it doesn't fit within the guidelines of a qualified mortgage, so you don't necessarily have to provide all those items.
Okay. Now, I am assuming, so, back in the last boom that we were in,
Yes.
One of the biggest things that made everything unravel was there were probably more of those what are now called non-QM loans than there were regular traditional loans, correct?
Yes, correct.
I mean, I was hearing people were putting loans in their dogs' names and stuff like that, but
Right.
that's
Yep.
not happening now,
Nope,
right?
Absolutely not.
There's
Right.
definitely regulation. Mm-hmm. Okay, that's good to know.
Yep.
So, definitely I do feel like this is probably a smaller percentage or a smaller portion of the population that are using these types of mortgages than the traditional Fannie Mae, Freddie Mac, conventional FHA.
Yes, it's definitely for the more knowledgeable person that can handle a loan like this. I wouldn't want it to get tied into the old subprime market because these are not subprime loans. So it still has you still have to prove your ability to repay.
Okay.
It's just you're not proving it with the traditional methods of full documentation.
Okay.
So, yes.
So what exactly, for the people out there that don't understand or know what subprime means, what does that mean?
So back prior 2012, it was called the subprime loan, almost like non-QM. And a prime loan was, good down payment, full documentation, very qualified to buy the house. Subprime just meant that you weren't providing those items. It wasn't a prime loan that could be sold off. It was a subprime market that was buying those, higher interest rates, higher risk, and it had some risk factors attached to it, like prepayment penalties. And those were very popular for primary residents back in the day, was a prepayment penalty. Now for primary residents, you cannot have a prepayment penalty anymore. They are only on investment properties can you have a prepayment penalty.
Okay, great. And prepayment penalty means that if you pay your home off sooner than expected, no penalties, no extra fees
Correct.
or anything like that associated with it. So go ahead and get those mortgages paid off.
Yep.
Yes. So, Greg, is this the same thing? Well, first off, does this have down payment assistance?
Good question. No,
Okay.
There is no down payment assistance. We say that the 3 C's of getting a mortgage, credit, collateral, and character. And so all of these loans are going to require at least a down payment that's coming from you. So
Okay.
none of the Home is Possible or Home at Last or anything like that, Sapphire, the down payment needs to come from you. Yes.
Okay. And can it be gifted?
On some of them, yes, the down payment can be gifted. That's
Okay.
that's okay. Just that there's no county or government entities that can that can grant your down payment for this loan. It needs to come from you or a gift.
Okay, perfect. Is this the same as a hard money loan?
Good question. No, and even hard money loans have been regulated now.
Maybe we should say what hard money loans are.
So hard money loans are even a higher level of risk. Generally, it might be a small pool of investors that are completely for the most part, non-regulated by Fannie Mae, Freddie Mac, and that are personally loaning your money for anything from buying a car to buying a home. Much higher interest rates, much larger fees. Think interest rates 9, 10, 11, 12%, and
Oh my goodness.
points anywhere from 4 to 5 points. So 4 points on top of your down payment. So
Wow. So
yeah.
hard money loans definitely a lot more aggressive.
It's definitely your last resort type loan.
Okay.
Yeah.
And those are, I think I've seen some hard money loans that have things like balloon payments where it's just a loan for like 2 years.
Absolutely.
And then you have to pay like this big balloon to pay
Right.
it off. Lots of risk factors. They're definitely not an attractive loan.
Yeah, they're used more for flippers. Someone that wants to buy an asset very quickly and then fix it up and then flip it. Not everyone would call that a hard money loan. It's just more the risk factor is higher, and so it has a market for something like that. But no, this is not a hard money loan. The terms are certainly not that aggressive.
Okay, great. So it's different than a hard money loan. Who exactly would this be a good fit for? What person or what person would really fall into the box of not being able to go with a regular qualified mortgage and need to go non-QM? Who would that work for?
Absolutely. Self-employed, where you can't prove your income. Maybe whether it's you're a doctor, you run your own business, and you have the money, you have the income to buy the property you want, but your tax returns don't show it. We're all allowed to write off as much as we're allowed legally on tax returns, and for these people, they may make $300,000, $400,000, $500,000 a year, but on their taxes it shows they may make $50,000 a year.
Oh my goodness.
So for someone like that, then there's maybe like a bank statement program. Maybe you've had a recent credit derogatory, whether you just got out of a foreclosure or a short sale. We did one recently where the person got out of a Chapter 7 bankruptcy, which is the complete wipeout bankruptcy. And traditional mortgages, you have to wait at least 2 years for a Chapter 7,
wow.
2 to 4 years. And we're able to get them a loan immediately. So they had already reestablished credit. They had a large down payment, and so credit derogatories is another one, and low FICO scores. So if you have a low FICO score, traditionally FHA on a good day needs at least a 580, but really you need a 620, 640 in FHA. You can get mortgages if your credit scores are below 580, but then again you need a good down payment, prove your income, that sort of thing.
Okay.
So.
Is there a set down payment amount that would be required on a non-QM? Do they vary based off of the person's circumstances, or what would someone be expecting to need as a down payment if they're going to have this?
Absolutely. So the least down payment that we have for these type of mortgages is 10%. So there's not a 5% down payment on a non-QM or anything like that. 10% minimum. If your circumstances, Chapter 7 foreclosure, then expect it, to start at, 20%. But you're still talking rates. What I always say is my first loan in '98, my interest rate was a very good interest rate. It was 7.25.
Yeah.
These interest rates are lower than that. So whether you talk to Trish or I, your parents, older family members about interest rates being 6 and 7%, and that being a good interest rate, these rates on non-QM loans are lower than that.
Right. I remember that my first house, it was 7.5%, and I just remember the lender saying, "Wow, you got a great rate."
Yep.
And now I hear people like, it gets up to like 4, and they're like, "Oh my gosh, the rates are so high." I'm
Exactly.
like, not really.
Yep.
There's still, it's still there's rates right now in the market that we're in today are still very good.
Absolutely.
And over time, if you look back, 10, 20 years, a lot different, a lot higher that they were back then. So
Right.
Definitely there's a change there. What about people that have, I know there's some kind of, and maybe you can help inform us or
Yes.
share this with us. I know there's some kind of restrictions on owning, if somebody were to own like investment properties and own like too many.
Right.
Because there's
Absolutely.
a certain amount that you can get mortgages on, correct?
Correct.
Okay.
So for many lenders, it starts at 4. That's pretty rare, though. Most lenders don't want to see that you have more than 10 mortgages.
That's a lot.
10 loans, and it's a lot.
Yeah.
So these companies will go beyond that.
Mm-hmm.
And these loans are particularly great for investors who want to buy a lot of properties. And so what they'll have is, one, if you can show full documentation that you can afford these loans, they're going to show all your rent from the other properties that you have to show that you can afford it, and maybe you go that route. There's 2 other routes. One, it's a bank statement program. You would show them all the cash flow that you have from the properties. So in your bank statements, you have all of your deposits going in there, and then they would determine your income based on cash flow in your bank accounts. One of the other very popular loans for investors is it's called the cash flow on the property. So your mortgage is $1,500, your rent is going to be $1,700. That's called a debt service. They're showing that, hey, your mortgage, your rental income is going to allow you to afford this mortgage, and they'll give you the mortgage based on that.
Okay.
Sometimes even if you're breaking even, they'll give you a mortgage based on the fact that you're doing, a large down payment, 20-25%, but that your debt service, your rental income is going to allow you to afford it, and you can buy as many of those as you can get.
Okay.
We have clients, 20, 30 properties doing debt service loans.
Okay, great. So one of the things that I'm taking away from this is that sometimes people might have applied for a mortgage or tried to get a loan. They want to buy a home and they've been told, no, you can't do it. Your credit score is too low, or your income, I hear that all the time.
Yeah.
Oh my gosh, sure. Yeah. Do you have like the 2-year requirement on the business? They have to have the business for 2 years. Or tax returns for 2 years if they're doing this type of loan?
We don't always need tax returns. And it could be as little as 1 year if you can at least prove that you've been in that industry longer than 1 year. So no, not necessarily tax returns for 2 years. In fact, most of these loans, we're not doing tax returns. It's just cash flow, that sort of thing. So
just being able to verify that you have the income.
Yes.
And there are so many people that have maybe been rejected for mortgages, tried to, because of these circumstances, which are very, very common.
Yes.
And this actually, there are options for them out there. The only thing is they have to have a bigger down payment. Interest rates are not as attractive as a traditional mortgage, but there's options, and for some people those options are fine because they can have this loan for a certain amount of time and then refinance into a more attractive loan at a later date.
Absolutely. Imagine you've had your foreclosure, and whether it's conventional that requires you to wait 7 years. If you wait 7 years to buy, you're spending all that money on rent. Property purchase prices go up, interest rates could go up. So maybe you get something that has a little less attractive terms, whether you're in your 4th or 5th year, and then we'll just refinance you into a traditional mortgage after that 7th year, provided, of course, guidelines don't change. But for the most part, your standard conventional FHA guidelines are pretty consistent. So same thing. If you just got out of a Chapter 7 or something like that and don't want to wait 4 years, but you have the down payment and you can afford it, why wait? one of the ones that we did that was after Chapter 7, the interest rate was below 6%. I mean,
Oh my goodness.
below 6%, no prepayment penalty, 30-year fixed. You know, it's a good loan.
It's still not a bad loan. It's still not a bad loan. Better loan than some of our parents got.
Yeah, absolutely. Yeah, definitely.
Absolutely. I've heard, I mean, I definitely was not around during that time, but I've heard that many, many years ago, 20 so years ago, interest rates were commonly around like 14%.
Yep. My parents bought their first house in Sacramento. I'm going to think it was in '84, and I think their interest rate was somewhere between 14 and 17%.
Yeah,
so
that's
people
insane.
were refinancing from 17 to 14 to 12, and yeah.
That's crazy. Could you imagine? But again, home prices were a lot lower back then, so
True.
I guess it all worked out the same. We're paying the same for our mortgages no matter which way you slice it. So definitely. Have we covered all the basic options for this loan? Are there any other options for this loan that we have?
So it's not just for the self-employed person. There are, if you in Las Vegas, naturally we have whether the service industry, bartenders, entertainers, that sort of thing, that make a lot of cash, that if they're on Tip Track 2000 or something else, that can't prove their income. I mean, we all know bartenders on Tip Track 2000, maybe they only have to claim $2,000 or $3,000 a month in income, but they make a lot more than that. So same thing, hopefully you're depositing your deposits in your bank account. We'll look at anything from 6 to 12 months of deposits. There are loans coming out that are only going to require 3 months of bank statements. A little different subset, but say if we're talking about, again, the service industry, 6 to 12 or 24 months of bank statements will come up with that cash flow to determine your income and then allow you to buy property with that.
Right.
So.
And there's a lot. I mean, being in Las Vegas, and this is a, service industry town.
Absolutely.
So there's a lot of people out there that are making very decent, very good money, but they're tips.
Right.
They're off tips. And that's one thing that I try to talk to people about, is it's great, but stuffing it under your mattress isn't really going to help you in, wanting to purchase. Because I've talked to many people that say, like, I have the cash, I can afford this, I have the money, I have no way of proving it. And so just simply depositing it into a bank account so that you can show your income, you can verify the income that you're making, because it has to be verified somehow. Right.
Yeah. If you start today, 6 to 12 months from now, whether you're talking to, with Trish and I, then at least you've started the process. Start getting those deposits in the bank every 2 weeks, something like that, and to start determining that income. Not a tax person, but as far as I know, if you're on Tip Track 2000, the IRS doesn't go then still looking in your bank statements to see if you make more. They're out of that. But then we would use that to determine your income.
Yeah. What is Tip Track 2000?
So in Las Vegas, because the service industry, they decided that they wanted to determine what people in the casino service industry were really making, and so they said, we're either going to audit you and to figure out what you're really making, or we'll come up with a happy medium to say, if you're a bartender at the Bellagio, we think you're making $17 to $22 an hour. And as long as you claim that you're making $17 to $22 an hour, we're going to leave you alone.
Okay.
And so in all aspects, valet, bartenders, everything. And
so it's a service basically that they sign up for or report or something in?
Right, exactly.
Yeah.
So they indicate, in your smaller bars, that sort of thing as well, and they say, okay, I'm telling you I'm going to make $17 an hour, and for the most part, you're not going to audit me. Anything I make above that, again, not a tax person, you're supposed to claim what you make, but it's a way to have a happy median with the IRS.
Yeah, and that's great. I've heard of those circumstances where people that are making tips aren't reporting them, and then the IRS always finds you. Don't stop trying to run from them. When people are like, oh, the IRS caught up to me or whatever, I'm like, you thought they wouldn't? They will find you. They will catch up to you.
And it's always us little guys. They're not auditing the people making tens of millions and billions. It's easier for them to come after the rest of us. So.
Yeah, that don't know any better, I guess. I don't know, but it's the way my perspective on that is just do do it. Just give them what they want. Make sure they leave you alone.
You don't want them. You don't want them looking into you. That's it's a feeling in your stomach you don't want. It's a lot more expensive to fight it. You're gonna pay. And then it comes down to buy. If you are hiding it, and then it comes down to buying a house, then you're paying higher interest rates. So versus if you claim the money and go that route.
I had a friend. They were looking into it. It was because of tips. She was a bartender looking into it or whatever. They opened up. They froze all her accounts. I was like, they have the right to do that. That's crazy. So definitely when it comes down to that, that's something that you want to make sure that you're reporting, but also it helps when you're trying to become a homeowner. Sometimes you don't think about that the first day, or whatever, that you start working, but there's a time in your life, everybody wants to eventually become a homeowner. It's, you'll get sick of paying rent, or you'll get sick of your landlord sending you a, a notice saying rent's going to go up, or a notice says, hey, I'm selling the house in 30 days. You've got to go. Homeownership is offering more security, and even though it is challenging today to find a home,
absolutely,
it's worth the fight in the long run. And if you can get into a circumstance that works for you right now, do it. Right. And you can always go into something that's more beneficial or attractive later, but you at least have that, your foot in the door there, your home.
Yeah, so when you're renting, you don't have that protection, and the Trish will tell you the rental monthly rental income charging is going up.
Yeah.
And so even though you might be paying a little bit higher interest rate on on a mortgage like this, first of all you have the tax write off, but there's no protection, there's no long-term investment when you're renting, and so with this type of mortgage, get into it, and we can always refinance you later into something that's more stable.
Yeah. Yeah, on my YouTube page, I have a little cartoon that just shows like a breakdown of like someone that's rented a home for 10 years and someone that's owned a home for 10 years and decided to move, and how much money the renter has lost over the 10 years that they don't get back, and they're lucky if they get back their deposit, which after 10 years you're probably not. And then the person that owned their home, they have the equity. They have this money when they sell that can put them in a better circumstance. Over time, renting just doesn't put you in that kind of secure financial position, and it just makes more sense. So, what about gig workers, like people that make, for instance, my daughter. My daughter has a business where she does art, and she makes these like ceramic. They're very cool, like ceramic things, and very she'll custom make them. It's actually Earth Honey Art. Check out her page. You can see what I'm talking about. Jewelry. She does all kinds of things like that. So over time, would she be able to use that income?
Absolutely, yeah. Whether it's her primary job or whether it's a secondary job, she can absolutely use that. Whether we would then, look at her full tax returns, and then maybe she needed still help from mom or something like that. You absolutely can. That's self-employment income. Or if we just looked at the cash flow into her bank, she absolutely can use that type of income. So, Uber drivers, some Uber drivers are full time, and then we would, or even like hairdressers, where we would look at it's like a PayPal account they have where all the money is being deposited each month. And so they're self-employed, but then we'd look at that cash flow to determine that income.
Food trucks. Food trucks are a huge thing here, and a lot of food truck owners are making a good amount of money. Especially the ones that have like a little location posted up in a parking lot and stuff. They're making good income off those. So there's a lot of those like freelancers and gig workers and things like that probably don't even know they have the options to own a home.
Absolutely. So in the same thing as say cryptocurrency, Bitcoin, that type of thing. So that's an asset-based loan, and so we are having young people that have tens of thousands or millions of dollars in Bitcoin, and they don't have income, or maybe they're doing more like a gig work type thing on side because they're constantly really just managing their stock trade, that type of thing. So it's an asset-based loan. If you can show that you have the amount to pay off the loan that you're getting, plus 50%. Or 5 years of debt service, they'll give you the loan based on that. So you'll need to have a track history of whether it's 12 to 24 months that you've had enough money. If your Bitcoin went from 0 to 50 in a week, no one's going to give you a loan based on that type of quick of an asset appreciation. But for those people who have had cryptocurrency for 1 to 2 years, they'll take that 2-year history. It shows that you're stable, and then if you're buying a $250,000 house and you have $500,000-$600,000 in Bitcoin, it obviously shows you can pay off the house and that you have enough debt service coverage for the next 5 years. They'll give you a mortgage. So again, that's not a Fannie Mae, Freddie Mac. That's more of a non-QM loan that we're talking about.
Yeah, absolutely. What about, we're in Vegas.
Yes.
So there's, and I don't know if everybody out there knows it, but there's professional gamblers in Vegas.
Yep.
And from my understanding, they cannot get a traditional mortgage no matter which way you slice it. That it's not considered income under a traditional mortgage, correct?
They would have to show a winnings history to prove that. So
Okay.
yes, they're professional poker players, and if you can show a history of winnings, then they'll allow you to do it. Or again, if you just hit the big one,
One time.
the one time, you got your bracelet, and you can show a couple of million. You show that you have that debt coverage to allow you to do it. And while we're sitting here thinking about it, ITIN loans would also fall within the realm of non-QM.
Okay.
It's different from DACA. But the ITIN loans also fall within the non-QM. So
Okay, can you explain what ITIN loan is, or who would
Absolutely.
qualify for that?
So U.S. citizens, permanent resident aliens have a social security number that that was issued by the U.S. government, whether it was recently or at birth. Then we have foreign nationals that have come in the United States and they've been working here, whether it's 2 years, the last 15 years, that were never issued a permanent social security number, but they've been issued an ITIN number. It's an identification tax ID number, and that you've been filing taxes under that number for at least 2 years.
Okay.
Then these lenders will say, hey, you're working, you're paying your taxes, you're contributing to society, we will give you a loan. And again, still has better interest rates than I got in '98, and that's a 10% down payment, as a start.
That's not bad.
It's not bad.
That's not bad. And that is the thing. If you're working, you're paying your taxes and everything, you should be able to have
Absolutely.
home ownership.
Right.
Yes.
Yep.
So that's awesome. I'm glad to know that there's so many options. Is there anything that we didn't cover? I feel like we covered a whole lot right now. Is there anything that I might have missed out on?
So let's see, people who with low credit, out of the 3 C's, you're going to need at least to have that down payment, and then you'll need to at least have the other 2. So whether it's good credit plus plus cash, or good credit then plus showing your income. But if it's I have bad credit and I can't prove my income, then that becomes kind of a problem. So you'll and then, again, if you have the income that you can prove, but your credit's low, then, that's what we do. We work on that. And Trish knows this for years. We have clients that, print out your credit report, come up with a game plan, and advise you what to do, whether it's, 3 months or 2 years to get you ready.
Yes. And it works. That's the thing, that if someone is motivated, they want to make it happen, it works.
Absolutely.
That we talk to people so many times that have no credit, just never built a credit line. And all they have to do is get one of those secured cards, or have someone add them to their account or something like that, start building that credit line. And over a few months, all of a sudden they have their scores, they're getting a score for one, and it's improving. So there's, no credit obviously is just not quite as backward steps as bad credit, but it's the same scenario. You can't get a mortgage with it.
Right.
So there's options out there, and don't be afraid to talk to us about what your options are. See how we can help you, because we can get you working towards that long-term goal and get success into you owning a home. That's the ideal goal for everybody. You want to be able to own your own home.
These loans, they're for foreign nationals. It's relatively easy to get a loan from somebody from the United States, or for Canadians. But if you're from outside the United States and you want that that second home or that investment property, then non-QM falls within that. You know, you have Airbnb income that you want to show.
Oh,
You know,
I never
Fannie
thought
Mae
about
and
that.
Freddie Mac, you know, they don't know necessarily how to deal with it that well. But again, these loans are for that as well, because again, we're going to show that cash flow that you're going to do. Because traditionally, when you're using rental income, Fannie Mae, Freddie Mac, they want to do an appraisal and then look at, you know, what is your rental income expected to be in the neighborhood. But if you're an Airbnb and the neighborhood's renting out for $17, $18 a month, but you're renting it out 6 or 7 times a month at $300 a weekend, $300 a day per weekend, you're going much above that neighborhood rental amount.
Right.
So if you can show a track record on using that income, Airbnb, well, now your income is not $17 a month, it's more like $3,500 a month.
Yeah.
And so they'll look at that cash flow again and rent based on that.
Oh, wow. Okay, yeah. And those short-term vacation rentals, there are areas of town where they're allowed,
Right.
and there are criteria. There's criteria that the city and state have for different things. If you're in an HOA, don't try it.
Yeah.
But there is certain areas that are eligible for that, and it is great income. I mean, I've seen the people that are making the income on it, and wow, it is a great source of income.
Non-warrantable condos, a lot of lenders don't want to do those. I'm drawing a blank, the condos that have rental income. Condotels, Fannie Mae, Freddie Mac doesn't want to give loans on condotels. So like the Palms, the residences.
The high rises?
Some of the high rises. I mean,
Yeah.
you can do loans on most of the general high rises, but Trump Hotel, the residences, Palm Place, where they're condotels, where you're part of a rental pool, where your property is rented out by the hotel association. Fannie Mae, Freddie Mac doesn't like to give loans on those. Non-QM lenders will rent out those as well. So yeah, you know, a little more of the out-of-box type properties that won't normally be done, they'll loan on them. So
Okay,
yeah.
good. And we do, with condos and traditional financing, you always got to be cautious. If
Yeah.
you have like a regular traditional loan approval, you're looking into a condo, and you know, so I have people, they're like, I want this condo. I'm like, well, that one doesn't qualify. There's so
Right.
much like red tape
Yeah.
when it comes to condos and traditional loans, for various reasons.
Yeah.
You know, sometimes it's more than 50% rentals in the community,
Mm-hmm.
or sometimes it's, you know, they're part of this litigation that will not allow financing basically on that condo. So there's a lot of
Absolutely.
red tape or yellow tape or
Yeah.
something that comes with
Yeah.
going into condos. So that's another thing. Good to know that there's options there.
Yep, absolutely. Yep.
So good. Thank you for sharing all of this with us. And Greg, how do people contact you if they want to reach out to you and ask some more questions?
Yep, Gregory Cooke with Castle & Cooke Mortgage. I can reach at 702-324-6229. Communicate any way you prefer, phone, text, email. And yep, I always say I'm 8 a.m. to 8 p.m. So available based on Las Vegas schedule.
Yes, yes, great. And I'm Trish Williams. We're here on Realty Check. You can text me, call me, message me, 702-308-2878. And tune in again next week. We're going to start our new series of the home purchase from start to finish. And week 1, I'm going to have another realtor with us, Ryan Field, and we're going to be talking about how to navigate through this like crazy market with buyers, you know, and what buyers should be doing. You know, my heart goes out to buyers these days. It's hard.
Yep.
It's
Yep.
rough for them. It
Yeah.
is a challenge. But how to navigate, just good tips on what to do to get your offers looked at, to have a chance to go up against these multiple offers, what you should and shouldn't be doing, and what it's like to get started, because it's easy to just give up right now, but at the same time, that, you know, we're definitely on, things are going up, and buyers do want to get secured and locked into a home right now. So
Yep.
tune in. We're going to give you some tips from us that are just out there in the battle zone right now of what we're doing. So tune in. We'll see you guys next week, and thank you for joining us.